Hey everyone, I'm Jeremy Szafron and this is Kitco News. Now we're focusing on the volatile commodities market today, and this volatility comes at a time of extreme geopolitical concerns in the Middle East. The recent drone attack in Northeastern Jordan claiming American lives has intensified global security concern, and its ripples are being felt in the commodities market, particularly in oil, gas, and in precious metals. Now our next guest says crude oil risks following gas back to its 2019 levels. Joining us to unpack these developments is Mike McGlone, senior commodity strategist at Bloomberg Intelligence. Mike, thanks for being on the show with us today.
Hello, Jeremy. Thank you for having me.
Of course. Now, there's so many things going on. Let's start with the recent geopolitical upheavals, particularly, of course, the attack in Jordan and the U.S.'s response. I'm curious how these events influence the global oil market, especially considering the strategic importance of the Red Sea region here.
Well, I think people are realizing how much more important it's become, particularly since Russia's invasion of Ukraine. A lot of that Russian crude oil is now going through the Red Sea and heading towards China. But it's the unique thing about the attack is typically these things are very bad for crude oil. Let's look at the most recent example, September 2019, when there was a significant attack on Saudi infrastructure, knocked out maybe 5 million barrels a day, pumped up WTI from to 63, and then it went back down. And it didn't really go back much up. So I think the situation we're in right now is the market's waiting for things like this for traders to sell.
Right.
And because we're a pretty significant bear market, that's just crude oil. If crude oil catches up to natural gas, it'd be around $50 a barrel or lower. If it catches up to corn, it'd be probably the same thing, $50 or lower, even industrial metals. So you can't look at it. I look at it right now, crude oil basically has a $20 premium compared to most other commodities are still collapsing. And it's just a matter of time it takes that out, in my view.
Okay, well, let's break this down because you mentioned a little bit about obviously what's happening. You recently tweeted, and we're going to show this tweet, WTI appears to an elevated threat of chasing natural gas back to the bear market that preceded the biggest liquidity pump in history in Russia's invasion of Ukraine. I'm curious, as we kind of look at the analysis of this, break down for the audience exactly what you mean here and what you see happening here.
So first, let's give an analogy of past performance. It's not indicative of future returns, but I was in the trading pits in the 90s when Saddam Hussein invaded Kuwait. Crude oil went from 20 to 40, went back down to 20. It bottomed around 10, maybe 5 years later, and took 13 years above that high. I see parallels. The key thing to remember is did it take for WTI to get above 100 in 2022? And that was not only the biggest liquidity pump in history, bar none, it was also Russia's invasion of Ukraine. That's a significant peak. Questions how long it lasts. And it was a lower high than the high in 2008, which was around $147 a barrel. Last year it was 130. And the pendulum swing in crude oil is normal. It swings too high and it swings too low. So right now we're clearly on that lower trajectory. And the key question you have to ask yourself is what stops it from doing what normally has for the since 2008, it's bottoming around $40 a barrel. I don't see a lot. You just have to watch China every day, look at the Chinese stock market. Yes, it's probably going to bounce. It's extremely oversold. But what's changed from a year ago, Jeremy, is that tilt towards a recovery in China has gone towards completely opposite. Everybody's understanding it's potentially following the path that Japan and the Soviet Union, former Soviet Union, followed about 30 years ago. So that's a pretty significant bearish factor. And then it's the massive, most significant factor, commodities, as the farmers say, it's the high price cure. And you're seeing that now. Virtually all the supply estimate revisions in petroleum, liquid fuel, crude oil, most notably from Canada and the U.S., are upward to records. And the demand estimate revisions for global GDP are downward. Now, you also see that in grains. Massive supply in grains on the back of that high price cure. So the key thing I enjoyed writing about 2 years ago when this invasion happened was be aware this is going to kick into the high price cure. And I think it's going to show that supply and demand elasticity is stronger than ever. So right now we're in that downward bend tilt in all commodities. Crude oil is just kind of lagging things like natural gas. And I asked myself, what's going to stop it? And I think the key thing that might accelerate it, just a little bit of pullback in this record setting U.S. stock market. That to me is the biggest risk we tilt towards a deflationary recession.
Yeah, and I mean, it's been such an interesting 2024 so far. Let's go back to your technical analysis because, of course, you suggested that WTI crude oil could trend towards that $40 mark. Tell us a little bit about what your projection is here, when you think that's going to happen, and a little bit about the factors leading to that.
So I have to be careful when I write for Bloomberg. When I speak, I say, I think it's going to go to $40 level. That's the level I expect it to go to. I think it may be kind of strange if it doesn't, but would be very unusual if it sustains above 90 or $100 a barrel, because you see what happens when that it does. It shuts down global economies. It restricts demand. It pumps up supply, and it makes central banks tighten more. That's the big problem. And as you can see on a technical chart, it hasn't been able to sustain above, let's look at WTI, above 90 since 2014, except for that major aberration in 2022. Yet it's been below 43 times. Point is, lower lows and lower highs. That's a technical outlook. And then I look at fundamentally, give me a good reason for it not to do that. I see it tilting potentially with China. And a good leading indicator has been U.S. natural gas. U.S. natural gas is the number one benchmark for heat, electricity, and fertilizer in this country. And the price we're seeing on the screen right now, about $2.50, was first traded in 1890. It shows a severe deflationary forces from commodities, particularly from a net exporter that might have a problem exporting more of it, and that's the U.S. and Canada. A pretty significant. I'll leave with this. I'll end with this. In 2008, when crude oil peaked, the U.S. was net importer of 11 million barrels a day, about that. Now, with Canada, the U.S. is a net exporter of about 6 million barrels a day, including liquid fuels, ethanol, and things like that.
Right. Yeah. And we're seeing this LNG ban take place, obviously, in the U.S. as well. Joe Biden talking about this. What implications is this going to have for the market down south?
So supply would become bottleneck. I mean, the key thing is that's kind of more sensational. There's a lot of LNG plants that are in the works still. Right. But the bottom line is also we have to look at our former President Trump was leading the polls and drill at will potential. The market started pricing some of that, which means crude oil at 50 is expensive. And if he gets reelected. So every day that goes by that he leads up in the polls, we see it. And there's a significant deflation there. And also just think if we don't have that, it's also the pre-existing trend if we get another a second term President Biden. So right now the market's got to start factoring all these things. I keep asking myself, what stops his trajectory? And I can tell you one thing that would accelerate, and that's the U.S. stock market. So the point is, the S&P 500 right now is up about 3% on the year. It's only January. Typically, the best years, it averages 8 to 9 to 10%. So we're already a third there. What more is there to do? It's not, can it lift that boat? But if it tilts lower, that's a severe deflationary domino effect that I'm more worried about. I think the market's starting to figure out those rates.
Right. And I mean, we're going into an election year, as you pointed out. Traditionally, historically, no one wants a bad economy going into these election years. Do you anticipate anything happening here that we should be looking out for?
Well, the key thing I'll point out is these are the pre-existing trends. The biggest risk, as everybody tells me, is that everybody is going to be wrong. Like a year ago, it was all considered recession. I was wrong on that, but I was right in a few things about commodities going lower. The thing is, right now, we've tilted so far towards the significant is that it's just assumed we're going to have a soft landing in this country. Yet Europe's technically in recession, and China's using significant fiscal and monetary stimulus to not go into recession. If we just get that little tilt downward, to me, that's the iteration that's not priced in the market, even close to yet. So I look at it as a ex-commodity trader. Now I'm just a strategist, ex-money manager. What's the risk this year? Is we just get a little tilt backward of this extreme sentiment that has swung, 180 from last year at this time.
Yeah, absolutely. We'll keep an eye on that. Let's switch over a little bit and talk about the relationship between Bitcoin and gold. Now, you've noted Bitcoin underperforming compared to gold as a risk asset indicator. I'm curious, Mike, I mean, as we head into 2024, what are the implications of this trend for investors?
The key fact I like to point out with all this, I would say, hype around physical ETFs in the U.S., which have been no problem in Canada, is the fact of underperformance lately. I love to watch the Bitcoin to gold ratio because it shows to me it's the most significant new digital asset on the planet versus the old guard. But that ratio in the past has led betas, led the S&P 500. But since 2021, since the biggest liquidity pump in history, Bitcoin to gold ratio has been lagging the S&P 500. So now we have this little bit of this crocodile jaw pattern. Bitcoin to gold has been kind of trading lower recently, and the stock market's taking off. So I'm concerned that I'll be on the list. I think this is the year that gold's going to outperform Bitcoin as we head towards a normal recession in the U.S. And partly because the key thing to remember is Bitcoin basically, and it's all its history, Even last year, if you look at last 10 years on a quarterly basis has about a 3 beta to the S&P 500. What that means is every time the S&P 500 goes up by 10% is our view is to let know Bitcoin goes up about 30%. So the problem is it's a high volatility, very speculative asset that everybody says it's supposed to keep going higher. But I look at it as if the stock market goes up, Bitcoin should outperform, but it hasn't shown its ability really to not underperform if the stock market goes down. And I think it potentially might lead that this year. That's just the risk.
Yeah, I mean, we see it almost evening out now with the volatility in terms of the spot ETFs you referenced and the inflows and the outflows. Any calls, any outlooks on what Bitcoin could possibly do this year?
Well, I'd have to be careful with that. It seems like it's pretty comfortable around this level of 43,000. The key thing to remember about the trade for the ETF launch last year was the Grayscale Bitcoin Trust. Everybody was up about 400%. Okay, that trade's done. It's over. The discount's gone. So maybe Ethereum will happen with the same thing in Ethereum, but I look at it now as, I look at more as a leading indicator. And I want to see this leading indicator prove that the stock market continue to make record highs. I think the risk is Bitcoin's still down over a third from its highs. That it's showing us that tilt we've seen global recessionary trajectories from commodities. I mean, virtually most commodities down and gold up is a recessionary trajectory. And the expectations from things like the very inverted yield curve. And then this, of course, this impatience factor. We all expected it last year, it didn't happen, but we are in the midst of some of the most significant money pumping, then dumping things ever. And then, of course, what's really kept the U.S. stock market and U.S. economy tilted stronger was a significant, unprecedented deficit spending during absent the recession or war.
Yeah, so much money going into the market. Leslie, obviously, let's get back to gold. I'm curious about your long-term perspective here. Is there any trends that we should be watching in the precious metals market that we should be, looking for, considering the global push towards sustainability and technology? I mean, is there anything that we should be really on the market for and looking at for this year?
ETF flows. So first of all, let's put it this way. The deepest pockets on the planet are buying gold.
Right.
Central banks. And there's a war going on. There's a little history there with wars and the price of gold. We don't have to get into that. But the way I like to see gold is, I've been saying for years, is gold to me is kind of naked if it doesn't have some of the digital gold in that space. It's just where the world's going. The fact is that ETF outflows, total known ETF outflows in gold have been down significantly despite gold making record highs. That's never happened. Now, ETF started in 2004, so 20 years of this data. And I think what's going to happen, at some point, those ETF flows will tilt to positive, but there's a reason not to buy gold. There's a record-setting U.S. stock market at 5% rates and T-bills. Once that changes, to me, that's where it's a pretty significant buoyancy factor for gold. So the way I see it right now, gold might dip below 2,000. That was old resistance that held for 3 years, but I see it building a base, and at some point, it's just going to take a leap towards 3,000. And a key catalyst for that will be if and or when we finally get this normal pullback in its U.S. stock market for U.S. recession. The problem is U.S. stock market relative to the rest of the world is so expensive. And I think that's what gold is anticipating. And so to me, it's the one commodity I still remain quite bullish. And I'm glad we went there because for commodity people, you want to talk about bullish things, and I'm kind of getting sick of talking bearish about everything else.
Yeah, absolutely. I mean, you mentioned it. Central banks are buying. I mean, we're seeing the buying power in China, yet it doesn't seem anything is really tipping up on that scale. So 3,000 gold this year. What's your forecast?
Well, I don't know exactly when.
Right.
To me, that's going to be the tilt. Is the key catalyst will be is once people realize, oh, yes, it's not going to be just a normal 20% in the correction in the stock market, and the Fed will save you. That's worked since 2011 like a charm. At some point, that has to give back a little. And particularly now that U.S. equity market versus things like GDP are about the highest since the 1930s. There's so many reasons there to see that gold will be the savior. But I look at it it needs that tilt. Right now, the quote I like to use is, why buy gold when the S&P 500 is at making record highs and you can get 5% in the U.S. T-bill?
Yeah, no, I get it. But the smart money seems to be going in there. Before I let you go, Mike, comments on silver as well. I mean, the step sibling that seems to never quite really do what gold does. What's your thoughts on this year?
Leveraged gold is what it used to be called. It still is. The issue is silver is at some point it'll break out higher, but I think it's more closely coordinated with industrial metals now, copper, nickel, and aluminum. And the fear I have is that industrial metal decline, which is like 17% on a 1 year basis, will continue as the world heads towards recession. Gold will outperform, and silver stuck in the middle. So between $21 and $26 an ounce, at some point it'll break out, but I'm fearful it's more likely to trade lower. Like I expect copper to head more towards $3 a pound initially, and there'll be pressure on silver. And like I said, unfortunately, I still see gold as, for I don't know how many years in a row, probably one of the best performing commodities, most notably versus industrial metals. And silver is now much more of an industrial metal than it used to be. And by the way, I'll end with this. Central banks aren't buying silver.
Exactly. Yeah. Just seems like they're dipping their toes into this gold market, doesn't it?
Well, it's somewhat historic. I just like I love the World Gold Council's data on that. And have there's ever been in my lifetime a better reason? And I say, absolutely, there probably hasn't been. And there's one unique factor about what central banks can do. We know the main suspects are China and Russia. They can print fiat money and buy physical gold with that. Now, at some point, they might buy Bitcoin, but right now it's gold.
Yeah, no, and the adoption is actually happening and taking place quicker too. Mike, it's great to have you with us today to break it all down. I appreciate you coming on. Thank you. Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence, joining us. Thanks again.
Thank you for having me.
And thanks everyone for tuning in. I'm Jeremy Szafron with Kitco News. Don't forget to subscribe to our channel for the latest breaking news, and we'll see you next time.